April 6, 1932. A lawyer in Youngstown, Ohio, sits down at the end of a working day and writes one line in his diary. Insanity and suicide among prominent businessmen is on the increase. That's the whole entry. He closes the book and goes to bed. His name is Benjamin Roth. He's not a banker, he's not a speculator. He's a working attorney with clients, a practice, and a habit of writing down what he sees several times a week for the better part of a decade. His son published the diary in 2010, and it is the most honest document we have about what it actually felt like to be an ordinary, educated, sensible person standing directly in front of the greatest buying opportunity in American history. Because here's the thing about Benjamin Roth. He saw it. He named it. He wrote down in real time in his own handwriting exactly what was about to happen and exactly what a person should do about it. And he did not do it. My name's Ben, and I've read 100 years of financial history, so you don't have to, because money has misbehaved in roughly the same ways since 1929, and the savers who came through did the same handful of things every time. 3 people, 3 crashes. 1932, 1974, 2009. Each of them documented. Real names, real dates, real numbers you can go and check yourself. And each of them shows you exactly one of the 3 moves that separate the people who come out of a crash rich from the people who come out of it with a story. Roth shows you the first move by not making it. Stay with me, because the third person in this video made the trade of his life, and then made a mistake that cost him about 60 times what he won. And he's the one who's most like you. Here's what everybody gets wrong about crashes. And I mean everybody, including me for a long time. We treat the crash as the event, the moment, the thing you either seize or miss. Buy the dip. Be greedy when others are fearful. Blood in the streets. You've heard all of it, and none of it is wrong exactly. It's just useless. Because all of it describes a decision, and by the time the decision arrives, it's already been made for you. If you take one thing from this video, take this. The crash doesn't make you rich. The crash just reads back what you did before it and after it. Before it and after it. The crash itself is about 90 seconds of your life. It's a click. It's an order confirmation. Everything that determines whether you're able to make that click was decided in the boring years nobody makes videos about. And everything that determines whether that click pays was decided in the years afterward, when the story got long and dull and you had 11 better ideas. So, 3 moves. Move 1, you had cash before it started. Not a plan to have cash. Not a line of credit. Not, I'd figure something out. Cash. Sitting there. Earning nothing, embarrassing you at parties. Move 2, you bought while the headlines were at their absolute worst, not after the all clear, during. Move 3, you held for 7 years or more, not 7 months, 7 years. That's it. That's the entire formula, and it is so boring that if I put it on a thumbnail, nobody would click. Here's the part that should make you uncomfortable. Every one of the 3 people in this video nailed 2 of these. Not one of them nailed all 3, and the one they missed is different every single time. Let's go back to Roth's desk, because I need you to understand how much this man knew. The numbers first. On September 3, 1929, the Dow Jones Industrial Average closed at 381.17. That was the top. On July 8, 1932, it closed at 41.22, 89%. Gone. And it did not get back to that 1929 level until November 23, 1954. 25 years. If you were 45 at the peak, you were 70 before you were whole again. Now, you'd assume, standing in 1932, that nobody could see the opportunity, that it was invisible. That's the comfortable story, because it lets you off the hook. Of course they didn't buy. They didn't know. They knew. In July of 1931, Roth writes that the magazines and the newspapers are full of articles telling people to buy stocks and real estate at bargain prices, that times are sure to get better, that big fortunes have been built exactly this way. He isn't discovering that. He's reporting the consensus. It was in print. It was everywhere. The following year, Dean Witter, the actual man, the founder of the firm, sent a memo to his own people at the bottom of the market. His argument was that America had faced major economic problems before, that conditions had always righted themselves eventually, that the only genuine uncertainty was the timing, and that the market as it stood was handing the buyer a splendid opportunity. He said great fortunes would be made out of securities bought that day. He was right. Exactly, precisely right. So the information was not the problem. The advice was correct, it was public, and it was free. Roth read it. Roth agreed with it. Roth wrote it down himself. And then, in December of 1931, he writes the sentence that is the whole reason this video exists. He says good stocks and bonds can now be bought at very attractive prices. And then he adds the difficulty. Nobody has the cash. Not, nobody has enough cash. Nobody has any. And here's a detail I want you to file away, because we are coming back to it at the end of this video, and it is going to sting. Benjamin Roth was working the whole time. He had a practice, he had clients coming through the door, he was not standing in a breadline. He was a professional man in the middle of the Great Depression, with an income, watching the sale of the century, unable to buy so much as a single share. Push on this for a second. Why? August 1931. Roth answers it himself, and it is the most useful sentence in a 400-page diary. He writes that he sees now how important it is for a professional man to build up a surplus in the normal times, and he puts a number on it. He says a surplus of $2,500, wisely invested during a depression, might have meant financial security for the rest of a man's life. Without it, he says, you are at the mercy of the economic winds. $2,500. Let me translate that, because the figure sounds like nothing. $2,519.32 is somewhere around $58,000 today. That's a real emergency fund. That's a number a disciplined saver watching this could actually have. It is not a fortune. It's a paid-off car and a cushion. Now watch what happens to it. The Dow bottoms at 41.22 in July 1932. 5 years later, in March of 1937, it's around 194. That is a rise of roughly 4.7 times, nearly fivefold, in 5 years. And it is still one of the greatest 5-year runs in the history of the American stock market. $2,500. In at the bottom, out in 1937, about $11,800, and that's price only. That ignores dividends, and dividend yields at the 1932 bottom were enormous, so the real number would have been meaningfully higher. But let's stay conservative and honest. Call it $11,800. Roth believed that was life-changing money for a man in his position. Given what a lawyer earned in Youngstown in the 1930s, he was almost certainly right. He didn't have it. Reset the example. September 1932. The market has already bottomed, though of course he cannot know that. Roth writes that the man who has money to invest in high-grade stocks now and who can hold on for 2 or 3 years will be the rich man of 1935. He is describing the exact trade. He has the thesis, he has the asset class, he has the holding period. In September of 1932, Benjamin Roth is correct about every single component. June 1933. 9 months later, he writes that he's afraid the chance to buy a fortune at about 10 cents on the dollar has passed, and that so far he has been unable to take advantage of it. That's it. That's the ballgame. The greatest buying opportunity in the history of American finance, opened, ran, and closed, and a man who saw all of it clearly, in advance, in writing, watched it go by from 6 feet away. And I want to be careful here, because it would be very easy to make Roth the villain of this video. He isn't. He's the most sympathetic person in it. He did nothing wrong in any way anyone would have recognized at the time. He earned. He spent roughly what people like him spent. He lived a normal professional life in a decade when that was considered prudence itself. That's what's frightening about him. There's no moment where he blows it. There's no yacht, no margin account. No stupid bet, he's just normal. Right up until normal turns out to be the thing that costs him everything. Which leaves you with an uncomfortable question. If the sale of the century opened next Monday morning, In cash, not credit, not "I'd sell something," not "I'd figure it out." What could you actually put in? That number is your move one. Everything else in this video is theory until that number is real. Don't skip this part, because the second half is where it gets strange. If move one is hard, move two should be impossible. Move two says you buy while the headlines are at their worst, not after, during. And everyone honest watching this knows how that actually goes. You don't. Your hands don't work. You've spent 11 months reading about the end of the financial system, and now you're supposed to log in and buy. Here's what nobody tells you about Move 2. The people who made it mostly didn't decide anything. Take the same person, 20 years older. Anne Scheiber. She retired from the IRS in 1944, at 51, after 23 years as an auditor. She never earned more than $4,000 a year, and was never once promoted. She believed, with reason, that being a Jewish woman in a 1930s federal agency was why. Her pension was about $3,100 a year. When she died in January 1995, at 101 years old, she left $22 million to Yeshiva University to fund scholarships for women. Now, the popular version of her story says she started with $5,000. Her own executor said the real figure was closer to $21,000. I'll come back to that, because it matters more than you'd think. What is not in dispute is what she did between 1944 and 1995. She bought blue chips she understood: pharmaceuticals, beverages, entertainment. She reinvested every dividend, and she did not sell, not through the 1973-74 bear market, when the S&P 500 fell about 48% between January 1973 and October 1974, not in 1987. Not ever. Here's the part that reframes the entire move. Anne Scheiber almost certainly bought the 1974 bottom, and she almost certainly never decided to. Her dividends bought it for her. Every quarter, straight through the worst equity market since the Depression, checks arrived and were turned back into shares at whatever prices existed that quarter, which is to say, the cheapest prices in a generation. She did not have to be brave on a specific Tuesday in October 1974. She had to build a machine in 1944 and then not switch it off for 50 years. That's move two, not courage. Automation, plus the refusal to interfere with it. If you've read this far and you're nodding too hard, here's what's missing. 3 things, and I'd rather say them myself than have you find them in the comments. 1. Roth was not wrong to be frightened. Reading him now, we know 1932 was the bottom. He didn't. From where he sat, "It gets worse" wasn't a paranoid fantasy. It was the trend line of the previous 3 years. If you're going to celebrate the people who bought, you have to admit they were taking a real risk that could have broken the other way, and that plenty of people who bought in 1930 and 1931, earlier, on the way down, were wiped out. Buying a crash isn't free. It's just usually right. 2. Scheiber's starting number. 5,000 versus 21,000 isn't a footnote. It's the difference between roughly 18% a year for 51 years and roughly 14.5% a year for 51 years. 18% for half a century would make her one of the greatest investors who ever lived, which is precisely why that version goes viral. 14.5 is astonishing, human, achievable, and almost certainly the truth. This channel runs the math the brochures leave out. So 14.5. 3. Survivorship. I picked 3 people who are documented because they're interesting. Nobody wrote a book about the man who had cash in 1932, bought, panicked in 1937 when the market fell again, and it did, hard, and sold. He exists. There are a lot of him. You're not hearing from him, and neither am I. Okay, now let me show you the man who did everything right and still lost. March 4th, 2009. Harvey Bookman, 60 years old, of Brooklyn, New York. Retired software executive. A regular guy with a Scottrade account, which should tell you everything about how ordinary this is. Bookman had already lost 70% of his holdings in 8 months. 70. And he kept buying. In his own words to the Associated Press, "I just kept buying because I had waited for this time my whole life." He had move one. He had cash because he'd waited for this. And he had moved two better than anyone else in this video. On March 4th, 2009, he bought Avis at 41 cents a share, 5 days before the exact bottom. The S&P 500 hit an intraday low of 666 on March 6th. The Dow closed at 6,547 on March 9th, down from a record of 14,164 in October 2007. He bought 41-cent shares 5 days before the bottom of the worst crash since the Great Depression. That is the trade of a lifetime. Nobody in this video did better. He sold them in September 2009, $11.92 a share. Total profit, net of commission, $46,026. 6 months, 29 times his money. He was thrilled, and he had every right to be. Here's where it gets worse. Work backwards from his own numbers and you can reconstruct the position exactly. $11.92 minus 41 cents is $11.51 of gain per share. 46,026 divided by 1151 is a shade under 4,000 shares. $1,640 in. 4,000 shares of Avis Budget Group. Avis hasn't split since 2006. Those 4,000 shares would still be 4,000 shares. On April 21st, 2026, Avis Budget Group closed at $713.97. 4,000 shares. $2,855,880. Harvey Bookman had move 1 and move 2. Perfectly. Better than almost anyone alive. He missed move 3 by 6.5 years, and it cost him roughly 60 times what he won. The crash didn't make him rich. It just read back what he did after it. And now I have to be straight about that number, because otherwise I'm a hypocrite. That 714 is a short squeeze. Two funds, SRS and Pentwater, ended up controlling something like 71% of the shares, the float collapsed, and the price went vertical and detached completely from a business that is currently losing money. That is not a fundamentals number. Nobody could have forecast it, and nobody should build a plan on one. So use the boring one instead. On July 14, 2026, Avis closed at $159.78. 4,000 shares, $639,000. $639,000 against $46,000. Strip out every bit of the madness and holding was still worth about 14 times what selling was. That's the honest version. It's still brutal. So here's the verdict. And then what to actually do, which in this case is mostly a list of things to stop. Step 0. I'm not your advisor. This isn't personalized advice, and I don't know your situation. Move on. Now. Everybody hands you a to-do list. You don't need one. You are not failing at crashes because you don't know what to do. Roth knew what to do. You're failing because of 4 things you are currently doing, and every one of them feels responsible. Stop calling your cash dead money. That phrase killed Benjamin Roth 94 years before anyone put it on a chart. Your emergency fund is not underperforming. It's a call option on the next crash with no expiry date, and the premium is the interest you're not earning. Roth's version of that premium was worth about $11,800 to a man on a Youngstown lawyer's salary. He didn't pay it. He couldn't. He'd spent it in 1928. Stop touching the machine when it looks stupid. Anne Scheiber's dividend reinvestment didn't know it was 1974. That was the entire point. If you have automatic contributions and automatic reinvestment running, the single highest value action available to you in the next crash is to not log in. Fidelity tracked 1.5 million workplace savers from June 2007 to June 2017. The ones who held their stock allocation through the collapse grew their balances by 147%. The ones who went to zero equities in the fourth quarter of 2008 or the first quarter of 2009 grew 74. Same decade, same market. One decision. Stop grading a crash purchase on a 6-month scorecard. Bookman's Avis position was up 29-fold in half a year, and he took the win. and the win was the mistake. If something is up 30 times in 6 months, you have learned nothing about whether you were right. You've only learned that other people are less frightened than they were. That's not a thesis, that's a mood. And stop waiting for the all clear. There is no all clear. There has never been an all clear. Which brings me to the thing this channel exists to tell you. Forget the panics. Everyone studies the panics. Look at the recoveries, because the recoveries all did the same 2 things. The first, every one of them began before the news got better. Not after, before. The stock market bottomed on October 3, 1974. American unemployment kept climbing for another 7 months, to 9% in May 1975. The stock market bottomed on March 9, 2009. American unemployment kept climbing for another 7 months, to 10% in October 2009. The bottom is not the day things stop being bad. The bottom is the day things stop getting worse than everyone already assumed, and you will not be able to feel the difference, because it doesn't feel like anything at all. It's just another awful Tuesday. The second, every recovery paid the people who were already positioned and charged the people who were waiting to be sure. From that 1932 bottom, the market ran nearly 5-fold in 5 years. Roth watched all of it. Front row seat, no ticket. 2 things. 3 panics. 94 years. There is no third thing. There is no version where the market waits for you to feel ready. If you're under 40, the next video is about the boring account that makes Move 1 survivable. If you're over 55, it's about what Move 3 does to a portfolio that's already in drawdown, because holding means something very different when you're spending. Now go back to something I said early on and told you would sting. Benjamin Roth was employed, the whole time, through 1931, through 1932, through the worst of it. He had a practice. He had clients. He had money arriving every month while he sat at that desk, watching the greatest sale in the history of American finance, writing down in real time exactly what he ought to be buying. He wasn't broke in 1932. He was broke in 1932 because of 1928. That's the whole video. That's the only move that isn't available to you during the crash, and it's the only one you can make today, on an ordinary Friday, with nothing on fire and no reason at all to bother. The crash doesn't make you rich. The crash just reads back what you did before it and after it. The experiment's been running for 100 years. The data is in. The only question left is what you do with it.